Over the last year, Amazon stock is down over 25%, but year to date, this thing is up 31%, including an over 7% move today alone. Is the company's Q4 earnings report, is it good enough to continue this momentum that we've seen year to date? Will this stock continue to move higher, or will we fall back under $100 per share on Amazon? Let's do something strange for a little piece of the change. I don't know what that means. Somebody told me to say it on Twitter. What is going on, investors? Hopefully, guys are doing well out there. Time to keep earnings season moving right along, and we are going to take a look at Amazon. Now, this is one of my larger holdings, but unlike a lot of people on YouTube, I don't give a crap if this stock goes up or down. I'm going to give it to you straight. And I think you're going to really want to tune into this earnings report as we got those Q4 earnings coming in at $149 billion over at Amazon. That was 8.6% year-over-year revenue growth, and it beat expectations by over $3 billion. They were solid earnings this quarter for Amazon. Wall Street was expecting a number close to 146, or about 6% growth. Again, we came in closer to 149. We also got one guidance. That is the quarter we're currently in with Amazon. Revenues expected to be between $121 billion up to nearly $126 billion. Now, Wall Street was expecting a number right towards that high end at about 125. In fact, when you look at the spread on Wall Street, it was 121 up to about 130. So they're kind of shading towards the mid to low end of that revenue guidance, and that's not necessarily going to make investors happy. We also got AWS segment results as well. We'll go through those in depth here on the channel, up just 20% year over year. I say just 20% because last year that business unit grew 40%. So Amazon's got some challenges in the upcoming quarter, and as we roll through these financials, we'll discuss the kind of things Amazon is going to be able to need to do in order to reaccelerate this stock price, which again, over the last year has actually underperformed, down 25%. And if they want to maintain this 30% type move in year to date, well, there's going to have to be some changes going on over at Amazon. Now, let's start things off with a statement of operations, essentially a profit and loss over this company. We're working on this second column here. 2022 is the second column. For most companies, it's the first column. Amazon just does things a little bit differently. Here's that $149.2 billion worth of revenue. Again, that was 8.6% growth year over year, and it beat expectations of, we'll just call that about $146 billion. Now, we won't just gloss over this, okay? There's not a lot of companies in the universe of investing that have basically $150 billion worth of revenue in a quarter. And you see for the full year, it's not like it just all comes in one quarter. Now, it is a big quarter for Amazon, but look over the last year. You had nearly $514 billion worth of revenue. There's very, very few companies. That is why investors have constantly given this company a little bit of leeway, because they understand that, number one, in the past, the company actually was accelerating their revenue growth rather significantly. And what we're seeing with Amazon is the expectations are, as we get towards the back half of 2023, and certainly as we get into 2024, somehow magically, this company is going to be able to reaccelerate their revenues back to kind of, I'm seeing like a low teens growth rate. When you have this much revenue, that is obviously going to be a tremendous challenge, because there's kind of that law and average of big numbers. It's going to be difficult for Amazon to reaccelerate to this double-digit growth. And if they don't do that, if you believe that Amazon is not going to be able to reaccelerate to a double-digit grower, well, what they're going to have to do is start driving operating profits. And so you come down here to operating expenses at Amazon, and we are seeing across the board, we are seeing increases. In fact, a massive increase into technology and content as they signed that deal with the NFL, probably a little something to do with that. $15.3 billion, up over $5 million to $20.8 billion. Across the board, you are seeing increases in expenses. So that took you from about $134 billion worth of operating expenses last year up to about $146.5 billion. So you take $149 billion on the revenue side and you minus off $146.5 billion. And yeah, doesn't take a calculator to realize you basically got no operating income over at this company. In fact, it went down from $3.5 billion last year down to $2.7 billion. You see, for the full year, actually paints a worse story than that. Last year, you had $24.9 billion worth of operating income. It got cut in half down to $12.3 billion. So the company, Amazon, is going to need to do one of two things in order to maintain interest on Wall Street. And this is just my opinion, but this company needs to do this. They either need to be able to prove to Wall Street somehow, some way that they are going to be able to reaccelerate these revenue growth. And I tell you what, when your number one business, one of your highest earning businesses, are now just growing 20% year over year on a quarterly basis, it's going to be a tall task to convince Wall Street that we're going to be able to reaccelerate towards the back half of 2024. There's also a lot of people that believe we're headed into a recession, maybe a deep recession in the middle parts to back half of this year. That's certainly probably not going to support double-digit revenue growth over at Amazon as we head into 2024. So the other thing Amazon can do to appease investors is start slashing these operating expenses, start firing people, start getting rid of unprofitable business units, start driving efficiencies at the fulfillment centers, just start cutting expenses. They did not do that in the most recent quarter. How they explain this to investors over the next 6 to 12 months will be critical to Amazon's success, because I am not of the belief that they are going to be able to reaccelerate back to double-digit growth. I actually think the easier path for Amazon is convince investors that you're going to slash operating expenses and take this $513 billion worth of revenue next year, which might be flat or up just fractionally, but slash these operating expenses and then drive profits for investors. Now, you pull all the way down to a net income number in the quarter for Amazon. It's a disaster, $278 million. I mean, that's basically zero. For the full year, you lost $2.7 billion, but some of it is complicated a little bit. You do have this other income or expense line. Last year, you took a credit. I believe this company has a large investment into Rivian, which makes up the bulk of this. So they recognized some unrealized gains of $11.8 billion last year that bolstered up your net income. This year, you had to recognize about a $3.5 billion loss, as that stock, among many stocks, are down considerably over the last year. And so it impacted that. That's why I would just make things simple. Whenever you analyze financial documents, stop here at operating income, operating profits, operating margins. And what you're seeing over at this company is they are sliding and they are going down. So the company has to do one of two things, ideally both, but more than likely with Amazon, they either need to reaccelerate these revenues. That would help the stock. I don't think that's possible. They're going to have to slash these expenses. So I'm sorry to all you pro-labor people. They need to start firing people. They need to get robots into these warehouses, and they need to start getting rid of people over at this company and start driving efficiencies. That's what this stock needs to do if it's going to be a winner in the longer term. Now, Amazon's always going to kick things off with the cash flow statement. This is actually the first financial statement that they show you. I tend to start with profit and loss because you pull down to a net income number. You also get an idea of the different types of expenses and the profit and loss. And so you pull down this paltry $278 million at Amazon, but you get to add things back in like depreciation, amortization. When you've got all this property, plant, and equipment, you tend to have a lot of that, to the tune of $12.7 billion in the most recent quarter. Stock-based compensation is accelerating. I'm not going to make excuses for Amazon, but when your stock is down over 25% year over year, well, it tends to accelerate stock-based compensation just a little bit, because in order to compensate people with the same kind of dollar for dollar value that they're used to, well, when your stock is down, you have to compensate them with more stock. So that can contribute a little bit to an acceleration of stock-based compensation, but I certainly don't like going from 3.7 up to 5.6. You see, for the full year, you went from $12.7 billion up to 19.6. I'm sorry, but they need to start firing people over at Amazon, and they need to get aggressive with it very quickly. This is simply not good enough from a stock-based compensation perspective, given the revenue growth and given the expenses and given the very little operating profits. They need to make some changes very quickly over the next 6 to 12 months with Amazon, or in my situation, I think investors are going to continue to lose interest in a stock like this. But here's the deal. You pull all the way down to net cash provided by your operating activities. A lot of that was also helped with last year. You recognized nearly $12 billion in kind of other income, not related, more related to that Rivian investment. This year, you get to add that back. So actually, your operating cash flows, which the company really just focuses on. So it might be management is just going to sit back and be like, no, guys, our operating cash flows went from $22 billion up to $29. We're all good. And you see, for the full year, it basically went flat. So we'll see which side management over at Amazon decides to go on. If they point to the increasing operating cash flows, or if they point to year over year, you're essentially flat on that. Now, they have cut some expenses on that property, plant, and equipment. This has been going on for a little bit longer period of time. Obviously, I'm talking about firing workers. That takes a while. You have severance, you have restructuring, you have like PTO payout. You have all these payouts where you could fire somebody and you actually don't recognize them kind of peeling off the expense side until probably 2 quarters later. So we're not really going to see the impacts of this until Q3, Q4 for Amazon. That's why it's more on management communication to investors that is going to drive the stock rather than the actual results or printing these results. But they have been shedding off this property, plant, and equipment, not opening up as many fulfillment centers, subleasing some of them, outright canceling some of them. And so you see to the tune of $18.9 billion last year, down to 16.6. You see for the full year, almost flat. I mean, it's not quite flat, but you were kind of flat on that purchase of property, plant, and equipment year over year. When you come down here to financing activities, you took on some short-term debt. You took on some long-term debt to the tune, and we'll call that about $19 billion. You repaid some short-term debt. All things being considered, when you factor in the operating cash flows, the slight slowdown or the pullback in the investment in the property, taking on some debt while paying off a little bit less than that, they actually increased the amount of cash that they had on a quarterly basis over at this company. When you come down here to the balance sheet, again, you recognize large amount of cash. So there's nothing really overly concerned about this company going forward. It's really just the investor perspective of this company. How long is this company going to go with really, really strong, high revenues, high dollar amount of revenues, but also a high amount of costs that basically offset that dollar for dollar? Those are the questions that investors are going to be asking, but the company has plenty of runway. If they just want to continue to break even for the next 10 years, the company actually probably can afford it pretty easily. Now, one positive that we are seeing on the balance sheet is the inventory year over year has been controlled relatively well. I would maintain the hiring of the people who are controlling this inventory. Last year, they were at 32.6. This year, up just fractionally to 34.4. So they actually done a nice job, because when we've looked across the board at inventories at Walmart, at Target, at Costco, at Nike, at anybody that carries inventory, it actually hasn't been managed this well. So Amazon actually did a nice job there. When you come down here, company's taken on some long-term debt, $48 billion last year, up to 67. But again, when you have $500 billion worth of revenue every year, and that doesn't appear like it's going to be slowing down. I don't want to make it seem like the revenue is going to be falling off a map. I just don't expect it to accelerate. So the company is going to have to pick one layer or another. They're either going to be no growth on the revenue side, but they're going to start printing profits, or they're going to continue to grow that revenue and the profits will just magically appear at some point for Amazon. Now, when you look at the different business segments, you've got North America. This is your e-commerce business. Here's what's disappointing, very disappointing as a shareholder. Last year, you had $82.3 billion worth of net sales. You bolted on $11 billion, almost to the dollar, $11 billion to the top line. But look at this. You didn't make a dime more. It's just... They got to do something at Amazon. You got to get rid. They have over 1 million employees. You got to get rid of 15, 20% of them somehow, some way. You got to get some robots or something doing these people's jobs, because it's the way it's being done right now is not working from an investment perspective. And it's not sustainable in the long run either, because all those people are going to need more money, more benefits, more time off as the years go on. So you got to start replacing these people. Last year, you lost 206. Again, we bolted on $11 billion. And you lost even more money, $240 million. Now, it is a rounding error, but you see for the full year, off of $315 billion worth of revenue growth, which again is a rapid acceleration over the 279, but you rapidly decelerated your operating incomes from $7.2 billion profit down to a negative $2.9 billion. So this quarter's certainly good, okay? This quarter better than previous quarters, because when you lose 2.8 over the last 12 months, losing $240 million is actually a privilege considering where we were. So they're moving in the right direction with Amazon, and it will be management's job to really convince investors that it's going to continue to move in this direction, and we're going to start printing operating profits to the North American e-commerce business. The reason why that's important is you come down here to the international e-commerce business, and it's terrible. terrible, okay? They actually lost revenue sales over the last year from 37.3 down to $34.5 billion. So they actually declined the revenues, and your operating expenses didn't budge a whole lot. So you actually lost more money. You went from $1.6 billion loss last year down to 2.2. Now there is probably some currency here, but I don't think there's enough to offset these net sales and this operating loss decline. So not good from that perspective, and also not good. You come down here to AWS and you see year over year, your net sales went from 17.8 up to 21.4. Again, on the press release, they talked about how AWS was 20% growth year over year. I'll show you that that's actually a rapid decline in the growth rate. But what's also troubling for some investors is look at your operating income. Maybe it's peaked, okay? Because when you look at the cloud segment, obviously you have Google, you have Microsoft, you've got Oracle, you've got IBM, handful of other players out there. In my opinion, kind of the easy contracts, all the enterprises that wanted to go from on-premise or whatever they had going on to the cloud, they've done it, okay? Cloud's been around for over 10 years now. And so really like 14, 15 years. And so everybody, all the big clients have already moved, okay? So we're seeing a lack of startups. We're seeing a lack of push into that. Now AI and these kind of chat bots that could reaccelerate that, but it's a different competitive landscape. You've got Google there, you've got Microsoft. And so what I'm expecting is the prices to continue to go down, the sales cycles to get longer. That's going to increase your operating expenses in excess of that revenue growth. And you see your operating income over at AWS year over year at Amazon, $5.3 billion down to $5.2 billion. So that also not good for Amazon. When we come over here and look at the different business segments and the growth rate, here's your online stores from a constant currency perspective. And we'll just analyze these all constant currency. There is some fluctuation, obviously, if you factor in the fluctuation in the US dollar versus different currencies. But you're basically flat on that online stores. That is why they've got to drive efficiencies there. And so I know there's going to be people in the comments, oh, we've got to save these $18 an hour jobs. No, you can't. You can't. Over the longer term, you can't at Amazon. You've either got to raise prices or you've got to start firing people. One of the two things. That's what they need to do with their online stores. Their physical stores grew 6% year over year. That is a slowdown. That was a double-digit grower. That has slowed down. Your third-party services, in my opinion, one of the ways you can drive efficiencies over at Amazon without firing anybody is look at your third-party sellers. This is your mom and pop that buys stuff wholesale or manufactures their own products. They're selling it on Amazon. All Amazon does typically for these sellers are provide some kind of support, but they take a commission off of each item, and they obviously do some fulfillment. Some sellers fulfill and send this stuff themselves through the Postal Service or through UPS, FedEx. This is a great business, and it is growing rapidly. In fact, it accelerated. Last quarter, you're at 23% growth. Now you're at 24. Last year, you were at 12. So in my opinion, Amazon needs to stop stocking TVs themselves, needs to stop buying and selling inventory, shed the inventory number, stop trying to be a first-party retailer like a Walmart and a Target, and just become a third-party marketplace for the vast majority of goods on the site. That's what I would do if I was Amazon. Then you don't need as many warehouse workers. Then you don't need a bunch of people buying and selling items and being a market maker in that sense. Just shed all those people and let third-party sellers handle all of that for a small commission fee. Now, subscription services, this is your Prime business. In the most recent quarter, you had that exclusive a Thursday night football game that the company licensed from the NFL. So you saw a small uptick in Prime services, 17%. It was 16% a year ago. You got your advertising services up 23%. That is a deceleration. Quarter over quarter, also a year ago, that was growing 33%. The ad business also ties into the fact that if you let third-party sellers take over a larger portion of the sales, because look, Amazon themselves is selling $64 billion worth of items. They let third-party sellers sell $36 billion worth of items. Guess who does a lot of the advertising on Amazon.com? It's actually third-party sellers. So if you let them inventory more and more goods, they'll advertise more and more. Instead, what Amazon does is they actually come in there and they undercut and they compete with the third-party sellers. In fact, there's lawsuits and class action lawsuits out there that Amazon is dealing with. Now, you come down here to AWS, it's not good. 20% growth rate there. Last year it grew 40%, and last quarter it grew 28%. So we're seeing a rapid slowdown there. The fastest growing business is actually this quote unquote other business for Amazon. That grew 80% year over year. It comes off a quarter where they grew 168%, and last year just 19%. You come down here to the footnote. Essentially what it is licensing and distribution of video content. My guess is they acquired those MGM studio assets and they're simply licensing this content out to the Rokus, the Netflix, the different linear TV networks. It's likely a low margin business, but it's growing rapidly from a revenue perspective. Now, when we come over here to the stock chart, the stock was up 7.3% during the regular trade, down 4%. So over the last 24 hours, stock's actually up. Now, what we are seeing with the technical perspective, this applies to all stocks, not just Amazon, is we have broken out. Okay. All of these stocks have been kind of in this downward channel since at least the beginning of 2022 for the most part. Most stocks have been in a downtrend. Some started in kind of the tail half of 2021. And you finally had a decisive breakout over the last couple of weeks, really this year to date. You're seeing it with the S&P 500. You've seen it across the board. You've even seen it very dramatically with a stock like Meta over the last 24 hours as well. Now, Amazon has pulled to the top. And here's the deal. There's going to be a lot of FOMO. There's going to be a lot of retail investors that think, well, this is the rally, just V-shapes us and rocket emojis us all the way back to the top of the all-time highs on a lot of stocks. The fact is that's not going to happen. Okay, there's going to be pullbacks in these things. A lot of these stocks are going to give this back, I would guess, over the next quarter or so. And from a technical perspective, it is perfectly normal. Okay, the reason why I'm not taking this black, we have broken out over this black trend line, but you don't remove it because you come and you back test on it. Okay, and depending on how long it takes to back test, I mean, if it takes into the summertime, you are back testing to the lows here on Amazon, but that is still technically, as long as you don't pierce through these lows back here at $82, this is technically still forming an uptrend. Now, if it happens more rapidly, you do a back test over the next couple of weeks, you run the risk of really kind of piercing through this, essentially ruling this as kind of a one-day kind of FOMO fake out with these stocks. And we'll certainly see. It'll be stock to stock. I don't think this will be kind of a market-wide thing. I think as stocks start to bottom, it'll be more, again, of kind of a stock-to-stock thing. But I would fully anticipate Amazon to backtest to this black line. That means we're coming south of $100 on this stock, probably in relatively short order, I would assume, over the next 3 months. If you have a long-term view on Amazon, which is of the belief that the company is going to be able to do one of two things, that number one, they're going to be able to just magically somehow, as we head into likely a recession, a lot of people are predicting some kind of recession to the back half of this year and into next year. I'm of the belief we've been in one for almost 12 months now, but look, I'm not an economist and I don't decide these things, but either way, it makes it hard to believe that Amazon is going to have to go to double-digit revenue growth. I don't think that's going to happen. I think there'll be kind of low single-digit revenue growth at best at this company. So if you believe that they're going to do low single-digit growth, you're going to have to believe they're going to be able to slash these operating expenses over the next 6 to 12 months. They've got to do that at Amazon, and they've got to communicate that with investors as well, that is the plan. That is what they're going to do. They're going to drive higher operating profits, higher cash flows, all those types of things. Now, the other thing that could bail you out is, we get some kind of soft landing and there's this bull economy that reemerges and everybody's got higher wages and inflation goes away. And then all of a sudden you reaccelerate to double-digit growth, and it basically gives Amazon a pass on cutting operating expenses because their revenues reaccelerate back to that double-digit growth. And again, double-digit growth on $500 billion worth of revenue obviously is a huge amount of money. And so it covers up a lot of inefficiencies on the expense side. That is why I'm not anticipating that as an Amazon shareholder. I think they're going to go on a rapid cutting and firing spree over the next 6 to 12 months. I think they've just begun over at Amazon. So it could actually be kind of a self-fulfilling prophecy that if a large employer like Amazon starts laying people off, well, it could trickle down into the broader economy. You will likely slow on this revenue growth, but That is the cleansing that this company needs. And then eventually maybe those revenues accelerate a little bit and you do it on a base of lower expenses and you start printing larger profits. That was Amazon. We'll be back again later today with Apple and Google results as well. Hopefully, guys have a wonderful day out there. Join us again tomorrow for the Friday Fang Stock Recap Show. Good luck with your investments.